This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 6, 2026, and this is the New York session. Now, let's get into it. Bitcoin is clinging to a razor-thin thread at $61,657, while the broader digital asset universe contracts into a state of pure paralysis. We are seeing a total liquidity vacuum with only $61 billion in daily volume, as the fear and greed index plunges to an extreme 14 out of 100. This is not a healthy correction. It is a structural unwind where institutional leverage has vanished and geopolitical shocks are flooding the order books. It is worse than a correction, narrator. This is a paralysis loop. The 7-day trend in our sentiment tracking has actually risen from 12 to 14, which means fear is accelerating, not resolving. We are watching retail investors flee in real time, and the market is completely ignoring any positive regulatory noise. Even though the U.S. Senate included a CBDC ban in the latest housing bill, a massive structural win for sovereignty, the price action remained strictly negative. That tells us immediately that liquidity demands are overwhelming ideology right now.
And that disconnect is dangerous because the broader market is asleep at the wheel. Look at the SIBO VIX sitting at 15 point. Equities are calm, complacent, pricing in a soft landing, while crypto is screaming in agony with a 14 score. It is a volatility mismatch. The traditional markets haven't caught up to the fact that crypto is deleveraging rapidly. You are looking at a scenario where the safe assets are ignoring the cracks forming in the shadow banking of the digital asset space.
So we have a divergence where equities are calm, but crypto is in freefall. Let's look at the headlines driving this specific pain. First, Cointelegraph reports that Iranian crypto outflows have spiked 700% following U.S.-Israeli airstrikes. Second, CoinDesk notes that U.S. authorities are seeking to recover $327,000 in USDT from a romance fraud scheme. And third, Cointelegraph reports that Bitcoin futures demand has fallen to 2024 lows.
The 700% spike in Iranian outflows is the single most critical flow variable today. That is a massive, non-organic supply shock hitting the market precisely when liquidity is thinnest. You don't need complex algorithms to see the danger there. You have sanctioned entities rushing to exit positions, adding sell-side pressure exactly when the bid side has disappeared. It is a perfect storm for slippage.
Exactly. And let's not overlook the mining sector stress. Core Scientific turned lower after disappointing fourth-quarter results. When your largest infrastructure plays are struggling with profitability, hash rate stability is threatened. You aren't just dealing with fiat-driven sell-offs. You are dealing with operational strain on the networks themselves. The VIX at 15 point is giving you a false sense of security, while the actual mining economics deteriorate.
Let me connect the dots there. SPECTER mentioned the VIX mismatch, but Pulse highlighted the accelerating fear. The reason the CBDC ban didn't spark a rally is because CIPHER just pointed out the Iranian outflow surge. The market is currently prioritizing immediate cash flow preservation over long-term regulatory clarity. Everyone is trying to exit the door at the same time, and the 700% spike in geopolitical capital flight has clogged the hallway.
That brings us to the primary anchor, Bitcoin. Bitcoin is currently trading at $61,657, down 1.62% on the day. It is testing a critical psychological and technical support zone. Grid, walk us through the structure. Is this a hold or a breach?
It is a fragile hold. The price is sitting exactly at $61,657. This integer level has acted as the primary anchor against the broader altcoin bleed, but the structure is heavily weighted toward downside risk. The key issue here is the derivatives void. With Bitcoin futures demand collapsed to 2024 lows, we have eliminated the institutional hedging layer that usually absorbs volatility. Without that leverage buffer, spot price discovery becomes purely directional. There is no cushion. A break below $61,657 exposes untested liquidity pools, and given the volume contraction we saw earlier, that break could be rapid.
Grid is correct about the lack of a buffer, but he is missing the composition of the sell side. This isn't just retail panic, it is institutional withdrawal. The fact that futures demand is at 2024 lows suggests sophisticated players are unwinding hedges or simply refusing to deploy capital. We are seeing a flight to quality within the ecosystem, but even that is strained. Bitcoin's dominance is holding at 55.52%, which sounds strong, but in this context, it just means everyone is running to the only lifeboat left while the ship sinks. The $61,657 level is only holding because there are no buyers on the other side of the trade, not because there is strong conviction defending it.
I'd add that the social sentiment around this level is deteriorating fast. The narrative isn't buying the dip. The narrative is this the bottom? And the answer from the crowd is increasingly no. The rising 7-day trend I mentioned earlier confirms that anxiety is compounding. People are seeing the volume drop to $61 billion and realizing that if this level breaks, there is no wall of retail money waiting to step in. The fear is contagious because the liquidity is absent. So, Bitcoin is a technical test with no fundamental bid. What about Ethereum? Ethereum is at $1,736.15, also down 1.60%. It seems to be mirroring Bitcoin's pain.
It is mirroring it perfectly. Ethereum at $1,736.15 is showing synchronized weakness with no internal alpha generation. In a normal market, you would expect Ethereum to either lead a recovery or decouple slightly based on its own upgrade cycle or staking yields. Here it is just beta correlated to Bitcoin's struggle. The 9.41% dominance figure is flat. There is no rotation happening. Money is not flowing from Bitcoin into Ethereum, it is flowing out of both. The structure is identical, weak buyer defense and high sensitivity to the macro liquidity crunch.
And that stagnation in Ethereum is telling. If capital were rotating, you'd see volume spikes in Ethereum relative to Bitcoin. Instead, we see the total market cap eroding to $2,227,000,000. The lack of movement in Ethereum suggests that large holders are not using this dip to accumulate. They are holding stable coins. The flow data shows capital standing on the sidelines, waiting for the dust to settle. Until Ethereum starts moving independently of Bitcoin's support test, there is no recovery signal in the alt complex.
Let's pivot to the outliers. Cardano is down nearly 5% to $0.18. That is a significant deviation from the mean. What is happening with Cardano?
This is a technical failure. At $0.18, Cardano has broken away from the mean with a 4.99% drop. This is not a general market bleed. This is localized structural damage. The chart structure suggests that previous support levels have been invalidated. When an asset drops 5 times faster than the broader market on low volume, it indicates specific fundamental stress or a targeted liquidation event. It is dragging correlated layer 1 tokens down via beta correlation, but the initial breakdown is self-inflicted by the loss of confidence in this specific protocol.
I agree it is structural, but look at the counterpart. While Cardano bleeds, Tron is essentially flat, down only 0.59% to $0.32. This reinforces the flight to utility theme. Capital is shedding story-driven narratives like Cardano and moving toward high-utility transfer networks. But in Cardano's case, the sell-off is so sharp it suggests there may be specific token unlock fears or exchange-related rumors distinct from the macro environment. It is a warning shot for smart contract platforms that rely on developer activity rather than transaction fees alone.
And do not forget the broader implication. If Cardano breaks further, it triggers stop-loss cascades. In a low-liquidity environment like this, where total volume is $61 billion, a 5% drop in one major asset can easily spill over into adjacent chains. The volatility is asymmetric. Downside moves require less capital to execute than upside rallies. So while Grid focuses on the level, I am focused on the contagion risk. One more percentage point down on Cardano could wipe out hundreds of millions in leveraged longs across the board.
We are seeing this dynamic across several majors. Solana is down 1.74% to $79.45, and BNB is down 2.36% to $570.98. How are these assets behaving technically?
Solana at $79.45 is acting as the high beta proxy for risk appetite. Its decline confirms institutional reluctance to touch high volatility layer 1s. It is a clean breakdown. BNB at $570.98 is weaker, reflecting broader exchange revenue concerns. Both assets are showing lower highs on intraday charts. The structure is bearish because every attempt to stabilize is met with immediate sell pressure. There is no accumulation phase visible in the charts, it is purely distribution.
This aligns with CIPHER's observation about the PayPay IPO. PayPay, 40% owner of Binance Japan, is seeking up to $1.1 billion in a Nasdaq IPO. On the surface, this looks like expansion, but CIPHER noted earlier that this could be interpreted as a distress signal or a need for capital injection. If the market views this IPO as a sign that central exchanges are needing fresh cash, it undermines trust in the entire exchange-centric ecosystem. That puts pressure on BNB and any asset tied to centralized liquidity providers. The skepticism around that $1.1 billion raise is contributing to the hesitation in buying Solana and BNB at their current levels.
What about XRP? It is down 1.97% to $1.11. We heard earlier about the Senate CBDC ban. Isn't that bullish for XRP? Should be. The CBDC ban in the Senate housing bill is a huge win for privacy and sovereignty. But Pulse is telling you plainly, the market is ignoring it. The sentiment score is 14. When fear is this extreme, positive news is absorbed and dismissed as irrelevant. Traders are too busy managing their downside risk to care about legislative victories. The price action proves that liquidity constraints override policy tailwinds. Until volume returns, XRP will continue to trade on technical weakness rather than regulatory hope.
And there is the risk flag on XRP specifically. It is decoupling from the policy narrative in a bearish direction. If the broader market doesn't bounce, XRP's relative weakness might persist longer than other coins because it has become a target for traders who think if it's going to fall, it might fall further since it's already bad.
Let's look at the smaller caps. Dogecoin is down 2.28% to $0.07. Meme are getting crushed.
Dogecoin at $0.07 is experiencing liquidity drain. Meme assets are the first to be sold when risk appetite vanishes. They offer no utility, no yield, and no defensive moat. The chart is simple. It is following the broader crypto market down with amplified beta. There is no support structure here because there was never a foundation to begin with. It is pure speculation, and speculation dies first in a liquidity crunch.
And notice the volume. The total 24-hour volume for Dogecoin is likely a fraction of what it was last month. The lack of buyer depth means that even small sells can move the needle significantly. It is a ghost town. The only place to watch is whether any major influencer tweets, but fundamentally, the flow is gone. Money has migrated to Bitcoin and stablecoins. Dogecoin is being left behind.
Finally, let's touch on TRX. Tron is down only 0.59% to $0.32. It is the strongest major mover by a wide margin. Why is TRX holding up?
Because it is a transfer network, not a speculation vehicle. TRX is used for stablecoin transfers and settlement. As traders move funds offshore, remember the 700% spike in Iranian outflows. They need a cheap, fast rail. Tron provides that utility. The demand for TRX is driven by actual transaction volume, not speculative bets on future adoption. So while Cardano and Dogecoin are bleeding, TRX is absorbing the flow of capital moving through the system. It is a defensive asset in a risk-off environment.
Technically, that makes sense. TRX is trading near its highs relative to the period. The structure is intact because the volume supporting it is organic, not speculative. It is not testing support, it is riding momentum generated by necessity. If you are looking for where the money is hiding in this mess, it is in the pipes, not the paint.
So to synthesize what we've heard, we have a market trapped in a liquidity vacuum. Grid showed us that Bitcoin's $61,657 support is technically viable but fundamentally unsupported due to the absence of futures demand. CIPHER confirmed that capital is fleeing to utility assets like TRX and Bitcoin, leaving speculative assets like Dogecoin and Cardano to crumble under their own weight. Pulse reminded us that sentiment is accelerating downward, ignoring the CBDC ban, and SPECTER warned us that the VIX mismatch hides a much more fragile underlying structure. The consensus is clear. This is a defensive posture. Volume is too low to force a reversal, and geopolitical flows are adding unexpected sell pressure.
Thank you to all our analysts. Let's summarize the key takeaways for your portfolio management today. First, Bitcoin is testing $61,657, but without futures demand returning from 2024 lows, there is no institutional bid to validate a bounce. Second, sentiment is accelerating in fear, rendering positive regulatory news like the CBDC ban ineffective for immediate price action. Third, capital is rotating defensively into utility-heavy assets like TRX, while speculative layer 1s and meme coins face disproportionate downside risk due to liquidity evaporation. Tomorrow, watch for follow-through on the Iranian outflow spike and monitor Bitcoin futures open interest. If demand remains low, expect continued spot selling pressure. This is ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.